More discussion on the 10 years on from the great financial crisis of 2008. With us in our Beijing studio, Xu Sitao, who is the chief economist from Deloitte, China. In London, we have Ian Begg, a professor at the European Institute and co-director of Darrenhall Forum of the London School of Economics and Political Science. In Irvine, we have Dan McGlory, who is the managing director and head of China and head of equity capital markets at the Boosted Securities. Welcome, gentlemen, to our program. First of all, may I have your opinion, Mr. McGlory, since you've been in investment banking for a long time and later joined by Mr. Xu, I guess. Are we near another crisis as we speak, if we are looking at the world market right now?
I don't think we are. 10 years is a long time, and many things have occurred since the global financial crisis. I think the main point is the global financial system is far less interconnected than it was a decade ago. And it's mainly due to a decrease in capital outflows. That foreign direct investment capital outflows are off globally by about half. So the world has grown, the economy has grown, debt has grown, but it's done so on a much more localized basis. So the possibility of contagion and the possibility of global disruption is far less than it was a decade ago.
Really? Mr. Xu, do you agree with that?
First of all, I don't think anyone can forecast a major financial crisis. But if you refer what we saw 10 years ago as evidenced by Lehman Brothers type collapse, I think that's a small likelihood event. But we are seeing sporadic stress of financial system, particularly in emerging market.
What exactly are you suggesting the stress, the nature of the stress, sir?
Well, the nature of stress really combination of factors. For example, high oil prices, rising U.S. interest rate, certain economic mismanagement, for example, in Turkey, South Africa. But investors are still reasonably informed. They are not using just one big brush to paint all emerging markets. The bottom line is most currencies right now are floating.
Okay. Professor Begg, it's time for you to speak out. Earlier, you have your two colleagues talking in different directions. Mr. McGlory was talking about, the world is actually very different from what it used to be, particularly when it comes to investment banking and also the debt market. Mr. Xu is talking about, well, maybe some challenges in the emerging economies. Maybe that's where things are likely to go wrong. Professor Begg, what about your opinion?
Well, I agree there is no immediate prospect of another financial crisis. But the one thing we have to remember is that every single financial crisis is unanticipated. Otherwise, it wouldn't be a crisis. If there was perfect knowledge of when a crisis was coming, steps would be taken to stop it. All the history of the last, let's say, of the post-Second World War years is that every single financial crisis has taken the authorities by surprise. The next one is not the same as the previous one, and very often what you find is the tools available to regulators and central bankers is very much like the old story of generals being very well equipped to fight the last war and not being able to anticipate the next war.
But when you look at what is going on right now, Mr. McGlory, particularly, let's just say, the two biggest economies, the United States and China, the trade war is not necessarily going to help either of the economy, at least in short term. For the longer term, exactly how the world economic system is going to be like and the trade system is going to be like, nobody knows. So these kinds of uncertainty, lack of confidence about prospect, what does it mean to the world economy?
Well, I think first of all, global leaders, business, central banks, they need to control the controllables. And I'll give you a perfect example of that. The Tier 1 capital ratio for European and U.S. banks has gone from around 4% to over 15%. Banks have become far more conservative. But what has this done? This has led to a rise in non-bank lending. So you have large digital powerhouses like Alibaba, Amazon, Facebook, Tencent that have created alternative financing and alternative bank-like systems. So that whole area needs to be watched. So maybe money has moved into that sphere where it didn't exist a decade ago. I think when we put into practice the main concern, which is let's not have any one particular sector concentration. And of course, 10 years ago it was real estate, it was loans that were way beyond the prices of property. You know, looking to avoid those kind of situations, I think, can leave us in the best status.
You haven't really answered my question. My question is about confidence. My question is about the credibility of the current international system. If we don't believe in the system, everybody go their own way, it is very likely we're going to have problems. And that certainly is likely to lead to another round of crisis, whether you name it economic crisis or other crisis. So maybe, Dory, what do you think about the trade war? Once again, it is only one of those examples between China and the United States. It's likely to be United States and Canada, United States and Japan, and also the other way around in many cases. So what does that mean, the lack of confidence, particularly this time?
What you're bringing up, Wei, is the questioning of institutions and the value of bilateral and multilateral relationships, and what effect does that have on the reliance on these systems. I think systems are being pushed to the side. I think past alliances are being greatly questioned through nationalistic movements in many countries, the United States included. But the trade war will not lead to a global financial crisis.
Well, the trade war will not directly lead to global financial crisis. However, the trade war is going to lead to a lack of confidence and therefore influencing the global market, including global markets in the developed countries and the developing and emerging economy ones as well. So, Professor Begg, what about that lack of confidence? Is it going to help us? Or is it going to actually give us more burden, leading to prevention of the next round of crisis?
I think that the lack of confidence may do two things. One is that it's causing what Mr. McCrory described earlier, which is a retrenchment inside borders. The interlinkages between parts of the global economy have quite clearly diminished, and that's going to be exacerbated if the trade wars erect new barriers. But the second thing it does is to create a lack of confidence in the global institutions, which have, since the 1940s, largely been behind the way global governance has functioned. Now, it may be that the International Monetary Fund in particular will find a way of coping with this, but we do have to recognize more generally that we're in a very new environment of monetary policy, where interest rates have been low for so long that the economy is only just adjusting to the idea that cheap money is there for the indefinite future. Plus we have the eventual unwinding of all these huge amounts of quantitative easing still to hit the economy. So that too is going to influence confidence.
I see. Mr. Xu, you've been a very close observer of China's economy and the recent trade war, but those are just examples of economies and trade relations. What do you make of that?
Chinese economy is very open, so trade sector accounts for over 40% of GDP. That's nearly twice of the ratio in the United States. So in the short term, trade tensions affecting China a lot more, mainly through the following channels. First of all, because the higher tariffs, so certain prices are going up, and which actually we feel actually very deeply. And secondly, for corporate investment, their behavior will be affected due to supply chain disruptions. And thirdly is really about confidence, and investors' confidence actually being affected adversely as reflected through lower stock valuation. Now, in the medium term, I suspect that's also going to affect United States, because trade tariffs is really working in a reverse manner of tax cut, particularly when stock market at a very high value.
There's another layer of this, which is when you look at the global economy, you want to look at also the new economies, so-called economic models. Some of those models, after the testing of a few years, just do not necessarily seen in many's eyes could be the potential of the future. If you look at Elon Musk's case study, if you look at Uber, for example, you look at the relevant cases of Facebook, people put so much emphasis on the new economy, but how much money will it really bring to us?
There is how much money they bring to economic activity.
Exactly.
There's also a question of how they're taxed. How they're taxed is crucial in this, because the ability of what we call the FANGs, the Facebook, Amazon, Netflix and so on, to pay far less tax than seems to be the case for more conventional companies, is a threat to the viability of governments' fiscal positions. So that's one consideration. But the other is, if you think about, let's say, another 10-year horizon. We're celebrating 10 years of, marking 10 years of the financial crisis. 10 years on from now, countries like China, much of Western Europe, will be aging very rapidly. And that is going to create a demand for new forms of services to deal with our aging populations. So the real generator of jobs is going to be the service industries, not these very high-tech things or the Elon Musks of this world. They are, if you like, on the fringes of the mainstream employment and the main forms of activity. And if I may make very quickly one other point, it is that we should avoid being seduced by the notion of the average. We talk about, on average, companies are doing well, they have good funding. It's the ones who are not well funded that are very often the triggers of problems, or the countries which are not well funded or in difficulty, like Argentina recently. These are the sources of potential new crises.
Well, for you talking about the service sector rather than the new economies, whether our colleagues from the investment banking are going to necessarily agree with that or not, that's a question mark, Professor Beck. What about you, Mr. Xu, about that point?
I think when we look at this dichotomy between new economy and old economy in China, I think the conclusion perhaps is clearer than what you see in the West. I think it's very clear, and there's overcapacity in many areas in old economy, but in new economy, the demand is not being fulfilled yet. We can also make the comparison. For example, in the West, credit card companies, they've been doing a reasonably good job. But in China, we never had satisfactory services of traditional financial service. So that's why we are embracing e-commerce. And that's why e-commerce in China is developing so fast and driving innovation. So I think the situation in China is very different.
It really depends on which kind of new economy we are talking about here, particularly Mr. McGlory, coming from investment banking's perspective, I'm sure you're much more clearer about this. Whether we're going to see whether those new economies, so-called, are going to be categorized as successful and non-successful stuffs, and whether they're going to contribute to our economy, or our economy going to drag down by some of those. Sir.
I think, in fact, an economy can be driven and certainly grown based on these alternative and innovative companies. And many countries are emphasizing that, China being among them. So I see this as a way to have a direct effect on the growth of GDP. Certainly the taxation aspect is a little bit elusive. I completely agree with that point. But the genie's out of the bottle, as we say, and it's not going back in. So these digital disruptors are going to continue to advance. China, as a country, has done a great job of supporting not only its national champions, but its global champions in that sector.
The genies are already out of the box, as you said. We hope the ghosts are not out of the box. We want to put them still into the box to avoid another round of financial crisis around the world. Before we go, gentlemen, I want to have one sentence from every one of you very briefly. What is wrong with us 10 years ago, and how can we make it right, even from now, 10 years on? Mr. Xu, you're closest to me, so you go ahead and answer that question.
Well, I'm speaking from emerging market perspective. China is the largest emerging market. I think the lesson is we should not pursue too high economic growth rate. In the end, that's often breeding bubbles.
Okay, Professor Beck.
Well, maybe I'll speak as a Scotsman and a taxpayer and say that one lesson from 10 years ago is that the taxpayers are not going to accept bailing out huge banks that have very cavalier approaches to their business models in future. And that may be the one big takeaway we have from the financial crisis.
And last but not least, Ms. McGlory.
Clearly, what happened 10 years ago was caused by irrational exuberance in the housing market, overlending, overborrowing, and a subsequent crash in housing prices. So That has to be addressed. We can't allow that to occur again, even in bubble situations. And to China's credit, when many major countries stood back 10 years ago, they launched a $786 billion stimulus package to literally start to get the world back on its feet. So that type of government intervention, in fact, can be very useful and very helpful.
I see. Dan McGlory, Xu Sitao, last but not least, Ian Begg. Really appreciate, gentlemen, for being with us. We hope we all work hard to prevent another round of crisis, no matter what name it is. Thank you. Really appreciate it.